Hi, I'm Glenn, and this is our special market take on the Fed Reserve's policy decision. The Fed kept rates on hold today as widely expected. Like at the Fed's March meeting, Fed Chair Jerome Powell reiterated the high levels of policy uncertainty. He again pointed to that uncertainty as the reason the Fed is standing pat on its policy stance. We previously flagged the even sharper trade-off the Fed now faces between protecting growth by coming to the rescue with rate cuts and reining in inflation. Powell was more explicit about that, referring to the risks of both higher unemployment and higher inflation. He also acknowledged that the inflation impact of tariffs may not be a one-off. If the current elevated tariffs on U.S. and China trade stay in place, we expect supply chain disruptions that could result in a supply-driven contraction in the U.S. this year. That's very different from a typical recession caused by weakening demand. It's more akin to what we saw during the pandemic. Supply disruptions quickly leading to a contraction in activity, but activity also picking up again quickly if and when those disruptions dissipate. That's also why we remain vigilant and are tracking a range of indicators to monitor how the supply shock ripples out. Those indicators include part traffic, capital spending plans, and financial and consumer spending data. We were watching to see whether Powell would acknowledge the supply-driven nature of any potential slowdown. The Fed was not explicit on that, leaving markets to read between the lines and with little guidance on the Fed's future policy path. Yet one brief comment on this by Powell was key. He said the Fed does not have the tools that are good at dealing with supply chain problems. We've long thought sticky inflation would make it difficult for the Fed to cut rates much further this year. Even as we expect a contraction in U.S. activity, the potential for it to be short-lived, as well as ongoing support from megaforces like AI, keep us overweight U.S. equities.